Howdy, Jacob here. Today we're looking at Align technology in the healthcare equipment and supplies industry. They are known for their Invisalign clear aligners and among other things. They were founded in 1997, already at 21.6 billion market cap and a billion less enterprise value, with growth being absolutely crazy the last 10 years. But we are seeing a very dampened growth post-COVID, where before they were growing, averaging low 20% a year CAGR. Now we're looking at mid single digits. And gross margins are actually down for 10 years ago. Operating margins are also down for 10 years ago. And return on invested capital and equity both down as well. We do see that there's little debt here. That's why the return on equity and return on invested capital are essentially the same. There's very little debt. But, not the best story being said as of now, especially seeing a 48 PE right now. Balance sheet has 972 million cash-like products with no short-term debt, no long-term debt. So that's a good sign. Balance sheet perspective, you're very safe, meaning that you have a lot of cash to go over your debt in the bad case that you don't produce free cash flow. But in the last 10 years, their lowest free cash flow is $200 million, or $180 million. So they're definitely doing fine from that perspective. And they are reinvesting quite a bit back into themselves. They are making solid acquisitions, and then they are a solid amount of acquisitions. I don't know whether they're good or bad, but a solid amount of net acquisitions, and then a huge amount of share repurchases. So I would say 80% of their money goes to share repurchases. The remaining 20 is kind of split between acquisitions and reinvestment. So let's start making some assumptions here. Really the question is, when I see this, I'm going to be more conservative based on the fact that the most recent 4 years have been fairly dampened in growth. But they do reinvest in themselves. They do make acquisitions. They buy back shares pretty heavily. So I just won't. If you understand this company and know that they'll get back to double digits, that could possibly help for these types of margins. That's going to help you out. But for me, being a fairly conservative man, just looking at the numbers initially, I want deals to be screaming at me. I don't want to find a deal. I want it to be shouting at me. So for revenue growth, I think I'm pretty comfortable with the 6%, maybe 17 PE, price to free cash flow, margins of, let's say, 20 and 18, and share change 1% would be about 210 million. That's it. Stock-based compensation, you're looking at about 360, and that's a good amount of their free cash flow. So I'll probably just do 1% a year, and that would be about 75% of their free cash flow going towards share repurchases. The rest, again, between acquisitions and reinvestment to get these types of returns. And we're saying it's a little bit expensive here. So I do think that business kind of had some changes the last 4 years post-COVID, which we see here. Growth is crazy, then it's not. Margins were a bit higher, now they're not. So this would definitely be a company, if you're thinking about investing in, doing some more research on this, being more comfortable with these figures, and just making sure that you're comfortable with your projections, because I'm pretty comfortable with these being fairly conservative. Will I miss out on a lot? Yeah, but the thing is, I want deals to be screaming at me, and I don't want to invest in 1,000 companies. I don't want to invest in 100 companies. I don't even want to invest in 30 companies. So I want to invest in deals that are so screaming to me that it has to be obvious to get in this great company, albeit, but just not at the price that is screaming attractive to me. But hopefully you enjoy the video. I'm very straight.